Welcome back to WWTA News. This is what we talk about news. Except for we're not doing news today. But bruh, this is WWTA News. What do you mean? You're just getting comfortable with not doing news here lately, aren't you? No, you can't even make up your mind. Bruh, what are you doing? I just want to conversate. Check it out. Look, today, hey, look, hold on. Before we get started, let me get y'all to hit that like button. Hit that like button. Don't waste no time. Hit that like button. All right, let's move along. We ain't gonna waste no more time. So, going through some stuff, some feeds, Twitter, checking out information, trying to keep up to date because, in the economy, when we're talking about crypto, stock, whatever it is, even just the economy, what's going on financially, you want to keep up to date. So, I'm just going through my little feed, checking everything out, and I see this thing with Gary Gensler. So, now, today, I want to talk about this video that Mr. Gary Gensler did because a lot of things we need to understand. Okay, a lot of things we need to understand. So it's important that we understand what Mr. Gensler is telling us about, right? And again, this is what we talk about news. And a lot of this stuff I've been learning over the years, and maybe a lot of people been learning stuff over the years as well, and then maybe they haven't. But if you're at this channel, I think it's good that we talk about this stuff, be informed about this stuff, and that we learn this stuff. So I'm going to be dealing with a lot of the stuff that he's discussing, so that when we have later later you can have discussions with other people, and then you're informed because you know what's going on, and then you have the information, especially when you can just look back to the video and go back to the conversation and pull up the information. So all right, so in the background you're probably seeing Mr. Gary Gensler talking. If you don't hear the volume, copyright obviously, but just read what he's saying at the bottom, if you so choose. But I'm going to tell you what he's talking about because I decided to go pull all that stuff up and pull it out and put it up on the screen so you can see it. So first off, one of the things that he's talking about is municipal bonds. So I wanted to go pull that up and put that in your face. It says municipal bonds. What are municipal bonds? All right, so it says municipal bonds, or munis for short, are debt securities issued by states, cities, counties, and other governmental entities to fund day-to-day obligations and to finance capital projects such as building schools, highways, or sewer systems. So municipality, right? Munis for short, are debt securities, and we know securities are contracts, right? So debt contracts, which means that somebody owes somebody, right? So who owes? Maybe people owe the state, maybe people owe the city, who knows? But the states and cities, they have these, and counties, they have these debt bonds, right? These debt contracts, and so they use those things and make them into municipal bonds, which you can then therefore purchase. And then we'll get to that as we read on. So yeah, right, this is what Mr. Gensler is telling us about, because I know a lot of people are attacking this Gary Gensler thing. Oh, he's attacking cryptocurrencies and all this other. He could very well be doing that, but here he's trying to really sell us into something, right? He's trying to inform us and get us to do what. And as I read through this, I just want y'all to think about this before I get to reading anymore. What if the United States is trying to get us to buy up the debt and then keep the debt within the United States? And so, before I read any more, let me give you my idea on this, what I speculate. And I could be wrong, but this is just for mere conversation. You can get in the comments box and post your thoughts below, but let me just put this out there. It's interesting that when we start talking about debts, because that's how the United States operates, it operates on debt, treasury bonds, so on and so forth, and banknotes and treasury notes. You know what I'm saying? Those are the record keeping of the debt. So that we already know in the United States, technically the only thing that can pay off an actual debt is gold and silver. And a treasury note is used no different in the United States, but it's only because the United States creates that debt note or that treasury note. So they can create it and circulate it and use it equivalently to pay debts in the United States as if it was gold and silver, because they're the ones printing it, they're the ones issuing it. You know what I'm saying? So it's like, It's a circle. You know what I'm saying? So of course they don't need gold and silver within their system. It's their house. They don't need it in their own house. But when you start to get outside of your house, say for instance you're dealing with other countries, China, Russia, so on and so forth, they want gold and silver or something of actual value for the debt. They don't want your in-house money. All right, so keep that in mind while we're reading about this stuff and starting to get an understanding. But let's continue. All right, so where were we? Okay, I know where we're at. So it says to continue, by purchasing municipal bonds, you are in effect lending money to the bond issuer in exchange for a promise of regular interest payments, usually semi-annually, and the return of the original investment or principal. Now, what they just said there to clear this up is when you purchase a municipal bond, right? You're acting like what? What okay. You're acting like at this point you're kind of converting yourself into a bank, right? Because now, a bank loans, right? A bank does a loan. They generate a contract. So you pick up the contract yourself, and now just like the bank waiting to be paid or the lender waiting to be paid, because that's what you're doing. You're lending money. That's what it says, right? As a municipal bond purchaser, you're lending who is this? You're lending the state, the city, or the county, or any other governmental entities. When you get this municipal bond, you're lending them money. So then you're going to get a return, right? So what do banks do? That's right. They lend money. Now, all this time, all these years, the banks were doing these overnight, the Fed was doing these overnight bailouts, quote unquote. Y'all remember this stuff. Don't play silly. So they were doing this stuff overnight so that when the banks opened up, they can continue to do business. What does that mean? Well, let's just kind of simplify it. What that means is they were being made liquid. They were getting money, numbers, so that they can continue to do contracts for people that wanted to get loans through the bank, right? So you go to your bank, you get a loan, because you don't go to the Fed to get a loan. You go through banks, you go through private banks, and you get loans, yada, 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 yada. So how are they able to do that? Well, first off, they have to have you, if you have a loan with the bank, your payments with interest is how the bank is getting money to continue to do loans. So that's the correct way to do it. I don't think that's how they do it at all. I think they, I don't think, I'm well aware that that's how we have inflation, and that's why you're having bailouts. It's because the banks just give out loans and they have nothing to give it value or nothing coming back. All right, you know what I'm saying? So anyways, when all that stuff was happening, the banks were being bailed out, and because money was being printed. Now, we look at what they're really telling us here with the municipal bond. They're telling you that you can effectively be no different than a bank if you want to get a municipal bond, and you're going to get a payment back, and you're going to get a payment with interest, just like a bank would when they do a loan. So Mr. Gary Gensler right now is trying to teach us that we might want to invest in the United States business by purchasing these municipal bonds from and let me repeat this, states, cities, counties, and other governmental entities. Now, to all those people that are true patriots, I think Mr. Gensler would be talking to you. As a true patriot, to put back, what better way to put back into your nation than to take your money and purchase municipal bonds, right? If you really care about this nation, this country that you stand proud for, right? Mr. Gary Gensler is offering you a way to keep it alive, right? Buy some municipal bonds. Now, why are you going to buy? Let me repeat this. Municipal bonds, or munis for short, are debt securities issued by states, cities, counties, and other governmental entities to fund day-to-day obligations and to finance capital projects such as building schools, highways, or sewer systems. By purchasing municipal bonds, you are in effect lending money to the bond issuer in exchange for a promise of regular interest payments, usually semi-annually, and the return of the original investment or principal. A municipal bond's maturity date, which is the date when the issuer of the bond repays the principal, may be years in the future. Short-term bonds mature in 1 to 3 years, while long-term bonds won't mature for more than a decade. So if you really want to take care of your home, right? You say, oh well, the Fed, is at fault for all these things. The Fed is not at fault for people's debt. People go out and create contracts with banks. People go into debt with their states, cities, counties, and their government. People do that. And so when those debt bonds are created, you then can purchase those municipal bonds, which are just debt bonds or securities or contracts for the payment of debt. You can purchase that and hold that debt yourself, and you can get rewarded that payment with interest, right? So if you really care, then that'd be something you do, right? Wow, this is some interesting stuff. Is anybody getting anything out of this? Is this not interesting? Let's continue. Generally, the interest on municipal bonds is exempt from federal income tax. Now look at that. Not only can you get these bonds to help save the country that you are a patriot to, right? This is some serious stuff here. You can also find yourself exempt from federal income tax. The interest may also be exempt from state and local taxes if you reside in the state where the bond is issued. Bond investors typically seek a steady stream of income payments, and compared to stock investors, may be more risk averse and more focused on preserving rather than increasing wealth. So you're not going to use a municipal bond to grow wealth. No. This isn't what that's for. That's what the stock market's for, right? That's the crazy stuff. This here is going to help preserve your wealth. And, oh, wow. So let's stop right there and let's think about this. Now let's think about you being in a position where you've now amassed a great amount of wealth. And you understand, as you're amassing this great amount of wealth, you want to then find some stability in that, right? So you look towards the bond market, and we'll get to that in a second. We'll just continue with the municipal bonds, because that's what, one of the major things is that he was pointing out, so I decided to pull it up. So let's talk about municipal bonds. So let's say you want to keep a steady stream of income coming in. So because this is how your money works for you, and you don't work for your money. You know what I'm saying? This is a bigger thing that Mr. Gensler is sharing with us. So let's just say you decide that you want to pick up some municipal bonds, right, to get that return of interest on it, and you want that to pay you an income of, I don't know, maybe you want to replace your working income of I don't know, maybe your working income is $2,000 or $3,000 a month. If you can pick up enough bonds that could pay you an interest of $2,000 or $3,000 a month, would you actually have to go work a physical job? No, you would just have replaced that with the municipal bonds, with their paying you out. Now, I don't know how they pay out. That's details of stuff I don't know anything about, but I'm just speculating based on that. That could be a very smart thing. I don't know. Again, I don't know much about it. I'll do some more reading, but that could be very interesting. So that's something to think about. I'm thinking about it right now. All right. But let's continue. Given the tax benefits, the interest rate for tax-exempt municipal bonds is usually lower than on taxable fixed income securities, such as corporate bonds with similar maturities and credit qualities and other items. Okay. All right. So then he also talks about security bonds, right? Secured bonds or security bonds. So what is securitization, right? We know bonds and contracts. What's securitization? Securitization is the procedure where an issuer designs a marketable financial instrument by merging or pooling various financial assets into one group. The issuer then sells this group of repackaged assets to investors. Securitization offers opportunities for investors and frees up capital for originators, both of which promote liquidity in the marketplace. So there's a lot happening right there. Capital's happening, originators or loan originators are happening, financial instruments is happening in this, and assets, right? It's a lot happening. There's a lot to unpack right there. But let's continue. However, securitization most often occurs with loans and other assets that generate receivables, such as different types of consumer or commercial debt. It can involve the pooling of contractual debts, such as auto loans and credit card debt obligations. All right, so I think we're starting to, before we unpack, reading this stuff is going to help us get a better idea of what's really happening here. So it happens all the time. Mortgages get resold, they get bundled up, packaged, and they get sold to lenders from other countries. And then you have foreigners contacting you for debts. All right, credit card debts, other debts like debts at a store. You might owe a store a debt or something. You know what I'm saying? All these debts. That's all they're telling you, right? A secured bond, right? That's what they're telling you. Securitized markets or securitized contracts or security bonds, right? They're packaged up and then they're resold. Happens all the time, right? It happens all the time. Well, what is an asset with that, right? So, because we're talking about loans, right? Securing loans and other assets that generate receivables, right? So we know what loans are. Those are bonds or contracts, right? So other assets. Well, let's try to understand what these assets are. An asset is anything of value or a resource of value that can be converted into cash. Individuals, companies, and governments own assets. For a company, an asset might generate revenue, or a company might benefit in some way from owning or using the asset. Okay, so we're starting to get some understanding of what that is. We know what the loans and the bonds are, but we want to be clear and sure that we know what these assets are, right? So we're starting to get some unpacking there with the assets. All right, so individuals and companies and governments, they all own assets. So it says personal assets. Personal assets are things of present or future value owned by an individual or household. Common examples of personal assets will include, and these are just common, just a few examples: cash and cash equivalents, certificates of deposits, checking and savings accounts, money market accounts, physical cash, and treasury bills. Okay, so money can be known as an asset. Okay, all right. Property or land and any structure that is permanently attached to it. And by that, they means if you got something attached to your home or to the land, right? So the land and the home. Personal property, including boats, collectibles, household furnishings, jewelry, vehicles. Oh, okay. So my car's an asset. Any jewelry could be an asset. Household furnishings, right? Liquidating a person's house is when you have an estate sale, right? There's an estate sale happening, or an estate auction happening on somebody's estate, in which they're going to auction off everything inside that home, including the home and the land, to pay off a debt, right? Estate. Investment, annuities, bonds, the cash value of life insurance policies, mutual funds, pensions, retirement plans, IRA, 401k, 403b, etc. Right? Stocks. So these are all personal assets. Now I think we have an understanding of what these personal assets are when we're talking about these municipal bonds, right? Okay. Now, your net worth, and this is interesting too, just a tidbit. Your net worth is calculated by subtracting your liabilities from your assets, and your liabilities are things you're still paying on, from the stuff that you're not paying on that you actually own. Essentially, your assets are everything you own, and your liabilities are everything you owe. Right? A positive net worth indicates that your assets are greater in value than your liabilities, right? A negative net worth signifies that your liabilities exceed your assets. In other words, you are in debt. So, I'm not sure if we all understand this, but this is like simple stuff that a lot of this stuff wasn't taught in school. And they didn't teach it in school. And so growing up, these are the things that children or youth should have been learning, so that when they got prepared to go out into the real world, they knew about value, money, wealth, assets. You know what I'm saying? Like this should have been taught in school when you were coming up, so that when you got out, you would know. All right, but it's okay. You're getting it right now. If you didn't know, now you know. It's right here in front of you. You know what I'm saying? All right, so, and this is all in regards to doing business. If you're going to do business, all this is all just about doing business, right? All right, let's continue. And so hopefully you understand, what they're talking about. Where does it say? Let me read that. Your positive net worth and negative net worth. That's simple understanding. That's subtracting your liabilities from your assets. If your assets are higher than your liabilities, you're in the positive. Vice versa, you're in the negative. And this is what banks look at when they try to get you a loan to finance a home for you, right? They'll look at your liabilities. They want a hold of your bank account. They want to see how much money on a regular basis flows through your bank account. They really want to see your spending habits if they can. They want to know if you have liabilities, whether you have loans out for this, that, and the other, because those liabilities, if they outweigh your value and assets and income coming in, then that determines the type of loan you get. So if you didn't know, that's what loans are all about. I know that everybody gets tied up in that whole credit thing, and for the longest time, it's been a very horrible thing because redlining and everything else. So, but That's not the discussion we're having. We're just talking about what Mr. Gary Gensler is talking about, right? Oh, wow, this has gotten long. We're up to 20 minutes. All right, business assets. So, for companies, assets are things of value that sustain production and growth. For a business, assets can include machines, property, raw materials, and inventory, as well as intangibles such as patents, royalties, and other intellectual property, right? So, as a business, those things are in the good for you. Those are assets of value that you own that are in the good. Now, a current asset, right? It says current assets are assets that can be converted into cash within one fiscal year, right? Or one operating cycle. Current assets are used to facilitate day-to-day operational expenses and investments. So stuff that they can turn over within a year, which they need to, if they need to pay, bills and stuff to keep their business running. That's what a current asset is. It's current, you know what I'm saying? Used right now. Examples of current assets will include, we're talking about businesses here, cash and cash equivalents. So that's treasury bills, certificates of deposit, and cash. Marketable securities, debt securities, or equity that is liquid. Accounts receivable, money owed by customers to be paid in this short term. So, debts. Inventory, goods available for sale or raw materials. Anything that you can sell immediately to get some funds, some tangible funds, boom, that's current assets, right? Fixed assets. There's two different types of assets for a business, all right? There's the current and now the fixed. Fixed assets are long-term assets or non-current assets, obviously. Tangible fixed assets are those assets with a physical substance and are recorded on the balance sheet and listed as property, plant, and equipment. PP&E, intangible fixed assets, are those long-term assets without a physical substance, for example, licensing, brand names, and copyrights. Some examples of fixed assets will include vehicles such as company trucks, office furniture, machinery, buildings, and land. The two key differences with business assets are non-current assets, like fixed assets, cannot be converted readily to cash to meet short-term operational expenses or investments. Conversely, current assets are expected to be liquidated within one fiscal year. Right, so we're talking about, we talked about what an estate sale, right? So if the Fed has to crack down and get money because stuff isn't paid, or banks have to get stuff isn't paid, they can do an estate sale. This is no different with a business. It's essentially the same thing. And a business can have an estate sale as well, where other companies come in and they auction for the supplies or anything in that building that they may want. So it's no different than an estate sale. So what Mr. Gensler is telling us is that we should reinvest in the United States debt by purchasing the debt, not getting a rapid increase of value from it. Look at it for a long-term period of basically keeping your money from depreciating, right? Because you're holding debt. Now, how true is that, or how good or how strong that is, I'm not sure. I'm not a financial advisor, but I know that the United States is living in a debt system. I know that they're not using gold and silver, and I know that they're not using a real currency that can pay off debt. They're just circulating the debt in this country through the people, through the businesses, because most countries outside of the United States, they're not dealing with that no more. That's why the United States is in a very tough place right now. So wow, look, share your thoughts there. Get a conversation going. Let me know what you think about that information. Let me know how you feel about Gary Gensler. There's a lot more things we can talk about, but this was a very interesting one. I wanted to share it, and I definitely want to get your thoughts on it. So look, enjoy. Drop some comments. I'll talk to y'all on the next one.